Hello, my name is Juuso Kaarasvirta and I come from Bank of Finland Institute for Emerging Economies, BOFIT, where I've been following Chinese economy for maybe 20 years now or something like that. These are my views, they are not necessarily views of the Bank of Finland, so that's something you have to keep in mind when you listen to this lecture. Uh, I will go through the overview of Chinese economy, but some issues will be discussed more thoroughly or, or will be discussed in other modules. So please check those out too. For example, I will not concentrate much on current problems Chinese economy has, but more on the trends and structures of the economy. So here's the outline. I will go through trends in the economy, so how Chinese economy has developed during the past 40 years or something like that. And I will discuss much on the structure of the economy and some basic concepts, how China manages its economy. Mm. So, like many of you know, China is now the second largest economy of the world. It has been growing very rapidly during the past 45 years, so from the start of the 1980. And why did China grow so fast? Well, there are actually numerous reasons for that. First of all, the starting point was really weak. So at, after the Mao era, Chinese economy was, I would say, a total mess. It was one of the, if you look at the GDP per capita, for example, China was one of the lowest countries in the world. You can find maybe from Africa some economies that were weaker at the start of the 1980s, but China was clearly like had fallen behind. Then China started, or they made a policy decision that they need to do reforms to get the economy going. So they started to open up and move from this socialist planning economy towards market economy. And it kind of started the economy to grow. They gave much more room for private enterprises, for example. They made uh, farmers, they made it possible for farmers to gain some, uh, to increase the productivity of farming, for example, and many other reforms. And nowadays, like I said, China is already the second largest economy. And then there was this rapid industrialization. It started maybe more on 1990s and continued on early 2000s. And it was supported by this opening up and learning from others. So China started to lure FDI, the foreign companies from abroad, to increase the knowledge of the industrial sector. So at the start, and actually already, maybe not nowadays, but during the early 2000s, they wanted foreign companies that moved in China to make these joint ventures with local companies, which kind of teached the local companies also how to uh, manufacture and make things more efficiently. Um, this was combined, of course, with urbanization of the economy. So when these a lot of these companies moved in from abroad, there were a lot of uh, they created a lot of jobs for farmers, basically farmers. So there was this rapid urbanization. People started to move from rural areas to urban areas, and it meant that you have to, of course, it's not just factories you have to build, but you have to build or expand the cities also. So you have to build houses, you have to build infrastructure, you have to build everything for these incoming workers. So this was one of these major uh, growth enhancers back then. But if you look at nowadays, this urbanization trend of people moving from rural areas to urban areas, it has slowed a lot during the past maybe 5 years or something like that. And currently, actually, China is already upper middle income economy. So it has, if you compare it to other economies, it's already like upper middle income economy, and it aims to become like advanced economy in the future. Even though Chinese economy has grown very fast during the past 45 years, if you look at the trends during the past 15 years or something like that, you can see that the growth has been slowing down quite a lot. In the past, we used to think that below 8% growth would have been a disaster for the economy, but now we are talking about something like 4 to 5% growth. And in the future, it will get even lower. On the left-hand side, you can see the graph. You can on the red line there is this official GDP growth. For China, there has been long this problem that can you trust the numbers they publish, because this GDP growth is actually political target for them. So when economic figure becomes a political target, it's usually so that there might be something that other things are driving the figure than the actual economic growth. On the black and gray areas, there you can see this profit alternative estimate for GDP growth. We have been estimating this for some time now, and the data is on our website. I put the link there under the graph. You can see from the black line there and the gray area that actually this Chinese growth has been maybe a little bit lower than the official numbers suggest for some time now, especially in the areas when there's pressure, lower pressure on the growth. So when the growth is very fast, then it tends to be so that our estimates actually go well in line with the official estimates. But when the growth slows down, it seems to be so that there's a pressure to show faster growth than the alternative estimate suggests. But even so, if you look at our estimate, it's still so that China has been growing very fast. There's no doubt about that. But maybe there's some problems with the official figures, especially because of the reason that it is a important political target. So which means that the like local governments and also the national government, they want to show numbers that are aligned with the set target. They set this GDP growth target every year, and it has been really important target for them. Like said, China is nowadays quite open economy, but not as open as EU, for example. So much more close than EU, but still quite open compared to, for example, India or some other major economies. And due to the fact that a lot of global manufacturing has moved to China, China nowadays covers something about maybe 15% of global goods exports. That's actually a huge share. So China is the largest goods exporter of the world. And it exports a wide variety of manufactured goods. So basically, every one of us has something that is made in China. Not necessarily, it doesn't say that it's made in China, but maybe some components, buttons from the clothes or something like that is made in China. But China is also a very large importer. So it's the second largest importer of goods after the United States. China needs a lot of raw materials, but it which it imports from abroad, like energy, but also it imports a lot of these finished goods and finished goods. Many of these are needed for the exports. So in China, the exports and imports usually go like hand in hand, at least somewhat like that. From the left-hand side, you can see there's trends in exports and imports. You can see that during this COVID pandemic era, actually Chinese exports jumped a lot. So we then needed a lot of stuff that was made in China, like masks. Almost all of them came from China, at least many of them. Then we stayed a lot of indoors at home then, so we bought furniture, we bought electric appliances to home. Many of those are made in China nowadays, so uh, it made Chinese exports boom. But during the past couple of years, when the pandemic shock has been moving or stabilizing, also these Chinese exports has been actually a little bit coming down. On the blue area down, there is this Chinese goods trade surplus. You can see that it's actually very huge. It's uh, over somewhere between 500 billion or 1,000 billion dollars per year. So that's the largest goods trade surplus any country has in the world. And if you Chinese service trade is actually on deficit, but if you calculate some goods and service trade combined figures, it's still something like 500 billion euros. China has surplus every year, or during the past couple of years. One of the important factors boosting this Chinese growth has been that they had a lot of workers there who had basically not much to do. And when they moved into cities and factories, it made a huge like productivity jump there. But this population or demography is a big problem in China nowadays because the population is actually getting smaller already. And if you look at the working age population or the economically active population, they have been getting smaller for almost 10 years now. So there are less workers in China nowadays than there used to be. And if you look at the trend, you can see it from the figure that this trend will persist for a long time in the future. And uh, there has been there has not been enough actions on this front to stop this. So Chinese population will get smaller and smaller, and at the same time, the uh, the retired people, the share of retired people of the population will grow very rapidly. So this is due to the fact that China imposed this one-child policy, and it was in place for a long time. Even though nowadays people can have more children than one, it made a huge impact on this demography. And people are nowadays also used to have one child, so they don't actually want to have more child because, well, raising children in China it's very expensive. And also in other countries, also when the standard of living is rising, people tend to have less. People tend to have or tend to want less children than they in less advanced economies. Uh, and some people are nowadays very work oriented, so maybe they don't want children at all, or maybe they don't want husband or wife at all. So they want to. Some people just want to stay alone, like in many other countries also. The average life expectancy in China is already nowadays 78 years. For men, it's 75, and for women, it's 81 years. So that's actually quite high in emerging economies like China. But the problem has been, or currently is, that actually the retirement age has been the same for decades. So China has not been able to increase the retirement age, or it has not wanted to increase the retirement age. So men can retire at 60 and women at 55 or even 50 if they are factory workers. So for example, women who is working at factory, he can be part of the workforce. If he goes to work maybe at 20, he works until 50, so 30 years, and then she has retirement for 30 years. So that's not maybe, well, that's a problem for the economy. And everybody clearly acknowledges that China needs to raise this retirement age. Even the Chinese people or Chinese officials are talking about this, but for, of course, it's a political decision, and for some reason they have not been doing this. And currently, maybe 2/3 of the people live in rural urban areas, when maybe 30 years ago, 35 years ago, only 1/3 of the people lived in urban areas. So you can see that China has this over something like 1,400 million people. So it means a lot of urbanization when 1/3 of the people have moved in urban areas during the past 35 years. Like I said before, Chinese economic growth has been slowing down during the past 15 years or so. China has been, to support the economic growth, China has been using fiscal space to boost the growth towards the numbers they have set politically, so towards the GDP target they have set. And this has meant that the fiscal deficit has been huge during the past 10 years or something like that. So on the graph you can see on the left hand side, on the yellow line below there is the deficit. During the COVID era it was something like 15% of GDP, huge number, but even before that it has been over 10% of GDP for a long time now. So basically during the Xi Jinping era, China has been using this fiscal space to boost economic growth. And it has, of course, meant that when the deficits are huge, also the debt has been growing very rapidly. On the gray bars, you can see the Chinese general government debt, which also includes some of budget activities they have. So it's this Chinese fiscal side is actually quite opaque, and you have to look not only the budget but also the off-budget activities of the government. Especially the local government is using a lot of these local government financing vehicles, LGFs, FVs, which are not on budget but are basically doing the same work as the government is doing. So investing, for example, on roads or something like that. And a lot of this extra spending they have been doing or to boost the growth, it has been this infrastructure or spending or other construction projects they have been doing just to boost the growth. It's not necessarily like they have been not thinking about is this if this or not necessarily thinking about if the investment is actually productive or needed. Sometimes it's just to boost the growth and do something. And it's of course in the end that's not the kind of projects you want to be doing. And actually, many of these local governments are now in deep trouble because they have been investing way too much. They are now they have way too much debt and they can't service it, and they have been using some inventive ways to pay their debts. And actually, some of the local governments have been already seeking some support from the central government. So in China, actually, the central government has not that much debt, maybe 40% of GDP, and most of the debt is on the local government side. And when China has been doing this stimulus of the economy, it's done through these local governments. And actually now they are talking about maybe the central government should be doing much more because many of these local governments are in debt, in big debt. Um, but this the whole system is quite opaque, very opaque, I would say, because these local governments they don't want to say how much debt they have. So the central government does not necessarily even know how how much they have been spending off budget. So it's a huge problem, and they are now talking about what they have to do with this. The good thing is that most of the debt is domestic, so it's maybe easy to it is much more easy to solve it. And at the same time, you can see if you look at the structure of Chinese economy, it's very much tilted on investment. So fixed capital formation on the left hand side on the graph, you can see this yellow line. So over 40% of Chinese GDP, annual GDP, is going to investment or fixed capital formation. It's a huge number. No other country has been having this kind of huge spending on investment for as long as China has. Maybe there have been like 1 year or 2 years some other countries, but not persistently like in China. So, like I said, this government has been doing a lot of this investment, but also companies. And many of these companies are, of course, state-owned companies, but also private companies are doing this investment. And let's go to the next slide then. So how it is possible to for one country to invest such a huge share of their GDP annually? Well, basically it's because of the fact that Chinese also save a lot. So people save a lot, and then they save to the banks, and banks lend this money to companies and this local government financing vehicles. And that's like the main channel. So they save a lot, and then they need to invest a lot. And Chinese save a lot because they kind of need to save a lot because there's not the social safety net is not that developed in China. So if you have to go to the doctor, for example, you have to pay. And if you want to, or if you have children, you have to pay. The schooling is not usually not free also. So there's a lot of money going to like to some activities which are here in Europe, for example, free or quite cheap at least. And so Chinese they can't like trust that the government will pay if they have some trouble. So they have to save for the rainy day. And banks play like pivotal role when they channel this money to companies as loans, and also to other households as loans for mortgages, for example. So in China, the financial sector is very much dominated by these big banks they have. So they are state-owned. Here are some of the big banks, or the biggest banks they have: ICBC, CCB, Bank of China, China Construction Bank. Big state-owned banks, and they are big also in like in global sphere. If you compare these banks, their total assets to other global banks, these banks are top 10 banks also there. In China and also in other, of course, in other economies, the central bank plays a key role in the money area or money sector because it decides on the price of the money when it changes the interest rate. And in China, the interest rate has been quite low for a long time because they have a lot of these savings, so you can keep this interest rate very low, but there's a lot of money to share. But then if you look at the bigger picture of the monetary policy system, in China they have a lot of the multiple targets, they have multiple tools, and the whole picture of the monetary policy is actually quite opaque. First of all, there's People's Bank of China. The central bank is not independent in China. It's under the State Council, so basically all the major decisions are made not in the central bank, but in the State Council. And like I said, they have multiple targets. So you have this sustainable growth target, you have this employment growth target, you have financial stability, price stability, exchange rate stability, and then you are using multiple tools. So even people like me who have been following Chinese economy, who work in the central bank, this system is not very clear, I would say. But they use it, and maybe in the future they will hopefully make it a little bit more clearer than it is nowadays. One of the good things for the monetary policy in China has been that the inflation has not been a problem in China. Here in Europe and in advanced economies, we had a spike in inflation during the past couple of years, but not in China. No, actually, the Chinese inflation has been very low if you compare it to other emerging economies like China. And it's maybe only these food items that has been like making some changes in inflation. If you look at on the left hand side, if you look at this black line, which is core inflation, so inflation excluding these energy and food prices, it has been very flat during the past 10 years, and it has been below 2%. So not much inflation. It's only this food and energy prices which have made some changes, major changes in prices. And not even if you look at this producer prices, the yellow line, it has been moving quite widely during the past 20 years or something like that. But it reflects in large part of the global raw material prices that have been changing during the past, or how they have been changing during the time. It's somehow a little bit mystery how Chinese inflation has been so low for so long time. And there are no good studies on that, so if you're interested in this issue, please do research on it. So foreign exchange rate policy is also of course important factor behind the management of the economy. China used to have this dollar peg, so the value of Chinese currency was pegged, so it stayed constant against the US dollar for a long time. But then they ended, and now they have been having this managed float for a long time. Sometimes it's more managed, and sometimes it's less managed, depending on maybe a lot of these circumstances. So basically, it goes like against the US dollar still. So they daily set a fix, and the currency is allowed to move minus or plus 2% against this from this fixed against the USD. To help this currency management, China actually has huge foreign exchange rate reserves. So it's currently something like 3,000 billion USD. It's the largest in the world. But it's not only this central bank who is nowadays doing this foreign exchange rate controlling. It seems that a lot of these state-owned or state-controlled big commercial banks, they are doing also their part to keep the exchange rate or controlling the exchange rate. Moreover, China still uses a lot of these capital controls, so money can't move freely from China or to China. Or in some cases it can, but not as freely as we have here in Europe, where we have like a totally free capital movement. So China controls especially like investment flows from China. So Chinese people cannot buy shares or equity from Europe or United States freely. On contrary, it can be really difficult. Well, of course, if you have a lot of money, you can find ways, but still. During the past 10 years or something like that, China has been making this capital movement a little bit more easy. They have been all the time punching some holes to these controls and make it a little bit easier, but it's still not that easy. And these controls seem to be at least somewhat binding still. Thank you for listening. You can find more information about Chinese economy from our website, where I put a link there, so it's easy to go there. Thank you. Bye bye.